Greetings everyone, I am Krisha Bhatia and today I will be presenting the chapter 10 of my macroeconomics book of CBSE class 12, Government Budget and the Economy. So February 1st is the day when our finance minister, which is currently Ms. Nirmala Sitharaman, they present the government budget. So what is this budget? Budget talks about two things. Number one, it talks about the financial performance of the government in the past 1 year. And secondly, it talks about the possible potential policies and the programs which can be introduced by the government in the upcoming one financial year. So these programs and policies which are proposed by the ruling party, the government, are also known as a budgetary policy or a fiscal policy, with fiscal being the term coined as something related to the government. So this budget talks about two things, the revenue aspect and the expenditure aspect. And both of them consist of expected receipts and expected expenditure. So the noteworthy fact over here is it is all about expected, the estimated thing, and it's not about the actual numbers related to whatever this budget talks about. The aim for making a budget is to ensure growth with stability. Growth talks about the rising up of the real GDP, and stability talks about correction of and curbing inflationary and deflationary spirals in our country. So government budget is a statement of expected receipts and expected expenditure of the government for the financial year to come that reveals budgetary policy or the fiscal policy of the government, whatever they've planned for this particular year. Then talking about there are three major objective themes we can say about preparing a budget. Number one is for ensuring a GDP growth, as I said, growth. Number two, it's about curbing the inflation and deflation, also known as ensuring stability. Thirdly, it's about reducing the inequality in the distribution of wealth and income in our country. So, as according to Jain, these three main themes have been summed up with 7 points talking about GDP growth, allocation of resources, as in how the government ensures that profit maximization goes hand in hand with social welfare. Thirdly, talking about redistribution of income and wealth, and this is ensured by imposing taxes to the rich, subsidies to the poor, and also ensuring a regular food supply for below poverty line people. Fourthly, it talks about provision of public goods, as private firms are not really interested in providing law and order and defense, etc. Fifthly, it talks about the balanced regional growth, as in, for example, there are special economic zones in our country, India, especially in Tamil Nadu, Kerala, and nearby to Chandigarh and Bandi. So they have tax rebates, tax holidays for promotion of business, for making these areas into industrial towns. Then next we've got employment opportunities. Government has been consistently investing in policies like MGNREGA, Mahatma Gandhi National Rural Employment Guarantee Act. So the government does investments to increase the employment in form of these schemes. And lastly, it talks about ensuring an economic stability, and which means avoiding as many as trade cycles possible, which are phases of recession, depression, recovery, and boom. So the stability is just to ensure that there is no inflation or deflation, whatever to extent it is possible in the economy. So talking about the next point, it says about the structure of the budget or the components of the budget. So these both words are synonymous, structure and components. It talks about two things, budget receipts and budget expenditure. Again, these both are estimated and not about the actual numbers. Okay, I missed this first point. It's about the fiscal discipline. What is the state of fiscal discipline? It means a state where there is a balance between revenue and expenditure, which means that the total revenue is not exceeding total expenditure and vice versa as well. Okay, moving on with the structure of the budget receipts. There are two types of budget receipts, revenue receipts and capital receipts. So again, in this whole chapter, revenue receipts, revenue expenditure and revenue receipts would be something which does not cause any change in the assets or the liability of the government. And again, capital, the word capital will signify that there is some kind of change in the liability and the asset of the government. So in the revenue thing, the revenue receipts do not create any corresponding liability for the government. For example, tax receipts, as they are unilateral payment to the government, people cannot expect anything back from the government, as in they have to prepare this road or anything. And secondly, these receipts also do not cause any reduction in the assets. For example, if you're going to pay a tax and income tax, you cannot really say that there is any kind of reduction in the asset of the government. In contrast, over here, something that is not a revenue receipt, for example, selling of disinvestment, selling of shares of Air India, for example, it already has been sold, but yeah, just a hypothetical example. Over here we've got selling off some government shares or assets. So this would be a case of capital receipt and not of a revenue receipt. Talking about the next, revenue receipts are broadly classified as tax receipts and non-tax receipts. Tax receipts again have 7 small components under it, with income tax, corporate tax, estate duty, gift tax, customs duty, excise duty, and goods and service tax. I'm not going to go deep into this topic because it's not covered in the book. And then next we've got non-tax receipts as fees, which means judicial and administrative fees, as in birth certificates, death certificates, death registrations, etc. Fines, which is basically the economic punishment of the lawbreakers to ensure that people follow the law. Next we've got escheat receipts, which talks about if a person dies without a legal heir, so the property goes to the government. We've got special assessment, which means that if the government has done some work in the area and the price of the property, for example, has gone up, so government takes into account special assessment and they have to pay this certain amount. And then comes the income from public enterprise, which, for example, railways, whatever profit they're earning from the PSUs. Then we've got income from the sale of spectrum like 2G or 3G, for example, whatever has been done in Kerala for 5G, and the bid was by Reliance Jio. Lastly, we have grants and donations. So these are also a source of income for the government receipts, which comes under non-tax receipts. Now, taxes can also be categorized into 3 forms: progressive and regressive tax, value-added and specific tax, and direct and indirect taxes. Progressive tax is a kind of tax like whenever our income rises, the tax which is put according to the income level, with slabs as for the income tax in India. That is an example of a progressive tax. The real burden of the progressive tax is on the rich and not on the poor. In contrast, regressive tax is something with a constant rate of taxation, as in GST. So the real burden, for example, the case of France prior to the French Revolution, the lowest level the commoners had to pay a tax. That was a regressive tax because the real burden was felt by the lowest section of the society, which is obviously beyond their affordability. Secondly, we've got the classification on the basis of value-added tax or specific taxes. Value-added, it means GST covers it all, as in whatever the value-added refers to whatever the difference between value of output minus the intermediate consumption. So at each stage, value-added tax is implied for the government. And then secondly, we've got specific tax. On specific tax, taxes are levied on the basis of units, sizes or weights, and they're also known as per unit taxes, especially prevalent in Europe. And thirdly, the classification goes as direct and indirect taxes. Direct tax is tax where the burden cannot be shifted to another person, that is income tax, wealth tax. And indirect tax is a tax where the burden can be shifted to another person, for example GST or customs duty. So important point is direct tax is progressive in nature, indirect tax is regressive in nature. And then talking about, we've already covered non-tax receipts, and now we're coming to the second topic of this receipts under the capital receipts. So what makes it different? What makes capital receipts different from revenue receipts? Capital receipts are those receipts which create a liability for the government, for example in the forms of loans by the government. So government is bound to pay them back, so it's a kind of liability. And for example, by reduction of assets, for example, if the government decides to disinvest, as in to share some stakes they've got in this MNC, so if they sell them off, they are reducing their assets. So that's why this is known as a reduction in the asset, hence comes under capital receipts. So capital receipts are again of 3 types: recovery of loans, secondly borrowings and other liabilities, and thirdly other receipts. Number 1, recovery of loans. So whenever we need to understand this concept, whenever the government gives out loans, they create their asset, as in it's an asset for them to give out loans to XYZ, any person, any institution, any firm. And secondly, whenever they borrow from people, borrow from RBI, people, market borrowings, or be it from IMF or anything, they create a liability for themselves, as they have interest and everything to pay back. So this creates a liability, and assets are in the form of lending to other people. So recovery of loans, borrowings and other liabilities, and other receipts like disinvestment, which I've already explained.